everyone, and thank you for joining our webinar. The title of today's session is Future-Proofing Your Construction Firm, Practical Succession Planning for Sustainable Growth. I'm Janice Kaplan from the Marketing Department at James Moore & Company, and I'm happy to be here you as we walk through building a strong business that brings success now while preparing for what lies ahead. We'll get started here in just a moment, but first we've got a few housekeeping things to mention. First, feel free to ask questions at any time during the presentation. You can use the questions chat feature, which is located at the top right of your webinar controls. I'll be monitoring the questions box, and any questions that come in, I'll go ahead and get them to our presenters as soon as I can. Also, you can download a PDF of the PowerPoint slides along with an in-depth checklist we'll talk about later at any time in the materials section. Guiding us today will be Webb Shepard, CPA and partner with James Moore & Company and the leader of our construction services team. We'll also be joined by Bob Weinhold, partner with Velocity Advisory Group. Now, each of our presenters is a wealth of information on all things transition planning, so you're in really good hands with today's information. And that's my part. That's all I have here. So with that, I'm going to hand it over to Webb and Bob so they can tell you a little more about themselves and get the program started. Gentlemen, go ahead.
Thank you, Janice. Hi, everybody. I'm Webb Shepard, a partner at James Moore & Company here, and I'm a CPA and a consultant to construction companies. And, you know, my clients, generally speaking, are excellent builders, but most of them didn't grow up thinking about enterprise value. I know this firsthand. My grandfather was a general contractor, so some of that goes in. Ironically enough, my father ended up being a CPA, so I get it from both sides there. The construction and the CPA kind of worked out for me, I guess. It was in my makeup before I was around even. So, you know, from my seat on the financial side of the house, succession planning is really more about financial credibility and risk reduction. You know, Bob has a different perspective, but that's what I focus on, you know, more so from the CPA consultant side. If the numbers don't hold up, the banks, sureties, buyers, or sometimes even your own management team, the plan is definitely going to struggle. And in this context, you know, clean books, we talk about clean books a lot, kind of surety ready books, but clean books here give you a lot of leverage. So that's what we'll talk about, at least from my perspective. And I'll hand it over to Bob here.
Thank you, Webb. Thank you, Janice. It's great to be here with everybody. I believe many of you are down in the state of Florida. I lived in Ocala prior to moving up here north of Philadelphia, so don't blame me for the cold weather. But it's great to join everyone, and sorry for your cooler temperatures this weekend. My background, that of a CEO, healthcare systems, having done a lot of work with senior level leaders in businesses on the leadership development and management side. But really over the last decade plus, I've focused a great deal on private ownership, ownership advisory, and really many multi-generation family businesses. In the construction world, many of the businesses have the same name as the family. And I spend a lot of time working with those businesses, not only to guide them to somebody like Webb and great expertise on the financial side for transition of equity. However, it's the leadership, the communication, and the understanding of how that framework operates when you've got existing non-family members in a business and you've got great leaders that may be coming up and need to leapfrog other people in the business. I often look at things on a standard privately owned business in terms of a management company, a board, and an owner group in 3 separate rooms. Some of you may have the board and the owner group be the same room. In multi-generation family businesses, we also have a family room that matters. So I kind of look at those things through a governance perspective, a leadership development perspective, and a succession perspective for a lot of families, from relatively small enterprises in the 10 plus million to the multiple billion-dollar enterprises that are really creating wealth for communities, creating impact and change, and making the landscape very differently locally, regionally, and in many cases nationally. So Webb and I are going to have a chance to talk about external succession and transition, as well as internal and what all those things look like. So thanks for joining us. What's the current state of construction? I'll put succession in a minute. Ground's frozen for most of you. It's not quite a go time for many of you in the company, in the country, depending on your projects, but it's certainly going to ramp up here really quickly. As far as the state of succession in construction, 50% of construction firms across the United States right now have owners 55 and up. 20% are 65 and up. And you add another 20% that are in that 50 to 55 range. When we look at succession, it doesn't happen quickly. It's usually, when done appropriately, over an 8 to 10 or 12-year period. So let's do the math pretty quickly. If you're in the mid 50s and up, and you want to get out or move, or you want to bring someone else in, or you want to transition and sell the hardworking asset that you've built over time, you got to get cracking. And that's a little bit of a challenge for some people along the way. So that's a lot of what's happening in succession in the country right now. Is there's such a large amount of ownership that is in the area and the age of getting ready to transition. And for many of you, not sure exactly what types of businesses you're in, but recognize that most of the current leadership and ownership of those organizations has the vendor relationships, has the financial relationships, has the client and customer relationships. And if those people are leaving and walking out the door, how does the next owner, leader, generation step up and do that? And do that without incurring things like risk. Webb talked about risk, and it's one of the areas that we're going to look at. So there's an aging workforce. You all know anywhere in the country that labor is a challenge. The complexity of supply chain has certainly been challenged in the last few years. And succession is a big challenge for many people. If you'll go to the next slide, Webb, that'd be great.
Yeah, and just to tack onto that really quickly, Bob, I mean, we're seeing exactly what you are on your side of the house. Really, more owners finally ready to transition, but, the business isn't ready. Like you said, 8 to 10 years. We'll talk a little more about that too. And a lot of these firms are still very founder centric, and that really hurts the value, which we'll talk about too, but agree with all that. Thank you.
Powerful. Does your business have a formal succession plan in place? I don't know, for those of you, if you could just enter in the question box a yes or a no, maybe we can see it populate. How many of you, for the businesses that you represent, have a formal succession plan in place?
So there's a book I read for the first time about a decade ago. It was introduced to me. It's called Exit Planning, The Definitive Guide by John H. Brown. I guess we can send that out or put it in the chat if anyone wants. It's called Exit Planning. And one of the points it makes, really a simple point, exit planning is really value planning, right, Bob? I mean, if you wait until a transaction is imminent, you have seriously limited the value of the company.
Yeah, and we don't want folks to get lost in that. So many of you have built really, really powerful businesses for a variety of reasons. Wealth creation, impact on the community. Some is to employ members of the community. Some is it to employ family values and your own family members. So folks have done that for a lot of other reasons. I wasn't able to catch how many of you actually have a formal succession plan in place, but 60% of owners of businesses that we've interviewed do not have any kind of a formal transition plan in place. And if they do, it's usually not complete, because when we look at succession planning across construction businesses as well as others, there are a number of aspects. I'm going to touch on some high-level ones, and then we'll shift into a little bit of greater depth. There's the financial component. There's equity. How do you transition equity? For many of you, and Webb and I've run into this recently with some of our common clients, and I've got other ones where the wealth and the bonding ability is attached to the primary owner and equity holder, and they're used for bonding projects. And when they leave or exit the business, if you're bringing in other family members or non-family members as owners, they frequently don't have the same ability to be able to bond projects, which can get you caught in a bind. We also have operational succession, and that has to do with FTE relationships, your employee relationships, your client relationships, your vendor relationships. And then how do you navigate success? Sometimes we see that there is a significant age gap between owners, and if it's in the family, the next generation stepping up and having that capacity. What do you do in the in-between? How does that work? And what happens if somebody in the next generation doesn't care to run the business or doesn't want to or won't be qualified for now or forever? So we try and help people look at those kinds of things.
Yeah, I'll say a little shameless plug here for Bob. I've seen firsthand the work that Bob and Velocity does working with family-owned businesses, and really getting everybody in separate rooms and interviewing people and really determining, because a lot of times it's funny, like you're kind of playing therapist to some extent, right? Okay, here's what everybody thinks is the agreement that they have in place, but once you get them in separate rooms and really start grilling them on these certain things, hey, maybe the next in line either isn't interested, or certain people might not, have the acumen for it, or whatever the case may be, but they do a really good job with that. It's been really fun to watch and be a part of.
Thanks a lot, Webb. I think the interesting part is if it's involved within a family or even multiple families in ownership, the therapy is more around communication, but it's about you have a very significant asset that is more than communication. And when it goes well, it spans generation and creates community impact. If it goes poorly, you're compromising really family relations, the opportunity for folks to have roles and jobs in companies and communities, and some of the philanthropy that many of your businesses support gets compromised. And that's a shame if it doesn't go well. Why don't we talk about some of the planning fails in construction?
Yeah, so why does succession planning fail? Sometimes, right? So they're usually not dramatic failures. They happen slowly over time, and really they could be easily avoided with proper planning, right? Proper planning prevents poor performance. Some of the common obstacles we see, and Bob touched on some of these, but no leadership bench because everyone's too busy, right? No time to train people. You ever heard that saying, I could have done it faster, but I had help? Mm-hmm. That's a pretty good one. Financials, at least from our side of the house, financials that are maybe good enough for tax, and I say maybe because we pretty regularly get a look at financials and tax return and find missed opportunities there. But so financials that are maybe good enough for tax, but not for decision making, especially from a buyer's perspective. Some issues we see with financials are inaccurate job costing, or just costs that unallocated that aren't job costed. Overhead allocation issues, if you don't have equipment pools set up or overhead pools, and if overhead is not allocated into jobs, I mean, that's a GAAP requirement. GAAP is generally accepted accounting principles. And so it needs to happen if you're going to go to market with your company, or really even just for bonding purposes and lending purposes. Other issues, with the WIP, sometimes we'll see job fade. So if you're consistently estimating at 20% gross profit, and then the jobs are coming in a little less than that, maybe they're at 15%, maybe they're 12%, that doesn't look, it's kind of like your ability to estimate, right? They kind of frown on that because they would rather see it the other way, but really they would rather see it dialed in so that it's pretty smooth and no wild swings when jobs close out. Oftentimes we see tax planning gaps, and by that we mean, hey, I want to sell my business for $5 million. It's worth $5 million. Well, did you think about the tax punch you're going to get with that? And did you figure that into your retirement income? So there's a lot of planning that can happen, I'm going to say months in advance, but really a solid year in advance is probably the right amount of time, because you can do a lot of things with setting up trusts and doing it the right way will optimize the tax burden there. We definitely see owners still touching everything important and holding on to way too much institutional knowledge. I mean, Bob touched on that, and it's so true. We see it from our side too. from a valuation standpoint, risk hurts value more than low profits, really. So the same profit does not mean the same value. And we see that oftentimes. So that's kind of what we're talking about here. How do you get the most value out of your company when it does eventually transition?
Real quick to jump in on that, that matters a whole lot. Internal succession or transition versus external. Private equity buyers that I've worked with, they often want privately run companies that are really good. However, if all the relationships are with the senior owner of that firm, when they buy your firm, they need you to stick around for a long time. And the value you get from the sale will very often be tied to the performance for the next 3 or 5 years. And so as an owner, if you're selling, that's a risk for them and it's a risk for you, because sometimes when people get the keys to the kingdom, they change everything. And it makes it real difficult for owners that brought it up in the ways that they did to have it all change and then not be able to deliver business and relationships in the same way they used to.
Good deal. So we'll go to the next slide unless Bob has anything else to add on any of these.
Nope. All right. Leadership and talent pipeline. That's an area that we spend an awful lot of time in construction companies. Part of the other side of Velocity does management training for folks, because oftentimes in construction companies, folks are really good workers. They do really good in their particular area. And when they're reliable, they get bumped up into new positions. And that can happen over several years or several decades, and they get into higher and higher management and then full leadership realms and roles, but they've never had formal leadership training. And so to imagine somebody came from doing kind of standard labor or estimating or all those things, and then is responsible for running a 10 million or a 50 million or $100 million construction company without P&L knowledge, without business analytics understanding, some of that creates a big challenge. Most owners that develop the companies learn that along the way, and they spend so much time and energy investing in it. But as Webb indicated earlier, they don't spend a lot of time sharing that. I've got more than a handful of owners that I worked with in the last 5 years that really don't have anyone in the company that understands how they do the financials and why they do things. So that's a loss of training, exposure, and expertise. So building development plans. Oftentimes when you've got a high potential leader, family or not, they enter the business, but there's not a plan. We just need to expose them to things. Or we don't want to create a position for somebody so they look like they get special treatment. Both of those have great validity in their own context. However, if you've identified somebody to eventually take over and succeed in a leadership role or an ownership equity controlling rights role, if you don't give them exposure across the business, they don't have common owner education and awareness. And so all of a sudden, if something happens to the owner unexpectedly, you've got that successor ready to go, identified, but they haven't been exposed to so many things in the business. That's a big challenge with succession. Identify capability gaps in the organization and in your leadership team. Then the question is, do you bring them in from the outside? Many of the businesses you all represent have core themes that have been built into your business. We promote from within. We value our own people. We treat people like family. All those things are really, really good and important. But if you need a skill set and you don't have it, how do you do it? Do you bring somebody in from the outside? How do you bring them in and do that in the right way where it doesn't compromise the way people think about the business? Cultural alignment, that's a really big thing. I've got a couple firms that I'm working with right now where they grew up with a very, very earnest place of a handshake and showing up on job sites. But that's when they were $25 million. And now they're $300 million. And you don't have the ability to access the job sites in the same way. And the owner-founder ethos is changed. And new people are coming in pressing ways that are corporatized or your ivory tower, and it really challenges people. So there's a lot of those components and how things are done. Webb mentioned the notion of how do you do things in financial practices? How do you manage that? How do you make sure that other people know that? That's a really important thing. I think before switching, this is a combination of the last slide and this slide. The thing that I find most interesting about ownership structures, from that owner room, boardroom, management room, and the family room, the thing that makes this part unique is that the decision authority and the emotional risk at an owner level don't often sit in the same place as the problem that you might identify in the business. So a management team might be trying to solve a whole bunch of stuff, but that's actually at a board level or an owner level, and people are either going the other way, have their head in the sand, or choosing not to deal with it. And it creates tremendous incongruence between the management company and the owner group.
Yeah, and just to tack onto that, what Bob's talking about on the leadership side, it's exactly what lenders and sureties and buyers want to see on the financial side. We work as advisors and consultants. So oftentimes, Bob will come in and work with the leadership team to kind of bolster that up and work with them as part of the succession plan. And meanwhile, we'll come in and we'll work maybe with the next gen and really get them honed in on the financial side. Hey, this is the whip, and not only are the mechanics of the whip and how it functions, but let's learn how to use this as a tool to help operate the business. And oftentimes, if you might have the next gen and they are great in the field and they've been working out in the field for 15 years or more, but they have no idea how the whip actually works and how it can be used, or even the importance of it to connect operations and finance. The importance of that, you've got to get your project managers on board with, hey, we need real-time data here to help the business operate better. And by the way, if the financial side of the house is operating effectively, we can oftentimes tell you, hey, you got a little bit of a cost overrun going on here. Maybe do you need a change order, or what's going on, really, to hold their feet to the fire. So that's been a lot of the fun stuff for me, is really getting into the consulting side like that. But again, back to the succession planning, I can't emphasize that enough. If the company can't run without the owner, it's going to be more risky. Less risky companies are worth a lot more to any buyers.
Absolutely.
So this is my side.
Yes.
All right. Let's talk about financial, tax, and operational readiness. So company valuation, it's more of a range than a real math formula. Yes, there's a formula behind it, but really it's worth what somebody will pay for it, right? Whether it's internal, external, ESOP, we'll get into that stuff in a minute here. But let's talk about the basics of how valuation works for a minute, because I think that's a misunderstood concept for a lot of companies, a lot of owners. So EBITDA, if you've never heard the term, it's earnings before interest, taxes, depreciation, and amortization. And that sets the starting point. So you take your net income, on your income statement there, and then you add back these things: interest, taxes, depreciation, amortization. If you're an S Corp, you probably don't have taxes, but depreciation, amortization, and interest all get added back. And then there are some other add backs, which we'll talk about in a minute, that can potentially get added back also. So EBITDA is the starting point, and then risk determines the multiple. So we've seen companies go for 5 times EBITDA. We've seen companies go for 25 times EBITDA. And the swings are all over the map. I've heard stories of companies going for a lot more than that and less than that. It all depends on the risk. So clean whip, huge, right? If the whip doesn't agree back to the income statement and the balance sheet, overbillings, underbillings on the whip, those need to agree back to the same line items on the balance sheet. Contract revenue for the current year, cost of goods sold for the current year, gross profit for the current year. All those 3 items on the WIP schedule need to agree back to the income statement. And if any one of those 5 things is off, that's kind of like, you do not, what is it, straight to jail card? You're not, if you're playing Monopoly, we don't go any further. Okay, let's just kick it back, get that sorted out, and then send me financials that make sense, because that's what they're used to seeing, right? Obviously, not obviously, I should say, another piece of that is that the balance sheet and the income statement, it need to be presented on a GAAP basis, and that's generally accepted accounting principles. And if there's any items on there that are not in accordance with GAAP, then they need to be explained. Even the internal financial statements. So one of the things we do is we have our companies update at least quarterly. Hey, send your financials over to us at least quarterly, and we're gonna, kind of beat them up for you, and we'll send them back with comments, and we'll work with the controller to get them in line with GAAP and keep them that way, so that it's smooth and consistent right into year end. That way, when you get your audit done at year end, you don't have these wild swings between your internal books and your year end audit. Quality and durability of backlog is a big one. Again, if you're having, job fade, generally speaking, and then you got backlog and all these jobs are sitting at 20%, they're gonna deduct for that, because you've historically shown job fade. So the quality and durability of backlog matters. Customer concentration matters. If you've got, we use 10%, that's sort of the GAAP rule, but it may be a little more than that before you start getting dinged on value. You probably get a slight devalue for 10%, but if you're at like 50% of all your work is with one customer, clearly that's more risk, right? If you lose that customer, you just lost half your work.
As an example, a government or city municipality contracts represent 50 to 70%. That's a higher risk business than a diversified portfolio.
Yeah, absolutely. Strength of leadership team, that's, we're still talking about risk here, right? How do we determine the multiple? Strength of leadership team, can't emphasize it enough. Can the business operate without the owner? If you've got a strong leadership team, you're probably doing pretty good. It should run without the owner if you want to maximize the value. Systems and internal controls over your financials are huge, right? If a potential buyer is coming in, they're going to evaluate the design and implementation of your internal controls, because they want to buy a company that's running. Even if they're going to buy it and roll it up and merge it, they still want it to operate under its own, foundation of internal controls. So if you've got gaps, if you've got potential holes in your internal controls, that devalues a company, because they know they've got to come in and do work to fix that stuff, if it's even fixable. And then of course it brings in the question of, well, if you've got holes in your internal controls, are there any other issues? Was there any fraud, for example, or anything like that? Because if you've got holes, how do you know? So again, 2 companies with the same EBITDA can be worth very different amounts. And even if you never sell, these same fundamentals make the business easier to finance, bond, and manage. If you've got everything in line, you're going to get better financing rates, you're going to get better bond rates, and of course, you can manage it so much easier because you got information at your fingertips. A good point here, just to kind of put that feather in your cap, transactional readiness costs should be tracked separately. So if you're spending money to get ready for any potential transaction in the future, buyers will add them back to EBITDA if they're documented, and you can show that. You can say, hey, this is not a normal operating expense. The whole point of EBITDA is to get back to hey, if the buyer were to buy this business, what would their earnings be? And so you can add back those one-time things, or those items that they would not then be incurring. So you want to track that separately. Another good point is to get with your CPA and run scenarios for tax planning. Also know what your number is. What number do you really need to retire? Oftentimes people, think they have a number in mind, and maybe they talk to their wife or their husband and they have a different number in mind. And guess what? Tax planning is a big part of that number. So.
And this would be one of those ego comments for owners, and it's really hard to say, and I say it with empathy, but vast majority of the time, the people that I work with have a much higher number than what the company will actually be valued at. And that's a hard thing for somebody to digest when you've worked to the bone for 40 years, growing a business either that you took over or from the ground up, and you put everything you have into it, and you go out to market, or you start doing estimate of value, and people say it's worth 2/3 of what you thought. And that's a real hard gut check for many people. You won't be alone in hearing that, but it's a very difficult thing for many people to swallow.
Yeah, another reason to start very early.
Mm-hmm. All right, so I get to talk about, at least lead off our discussion of 5 succession models for construction companies. And I'm going to try and talk about this, and I think Webb and I can try and talk about this, is there's a difference between ownership, succession, and transition, and leadership, succession, and transition. Both matter. Ownership, succession, and transition is predominantly why we are together. But as Webb is talking, if you're going to sell to an external buyer, a private equity group, a larger privately held group, your leadership succession planning and changing in the previous 3 to 5 years matters. It matters from a risk understanding, it matters from a company culture, and all those kinds of things. So let's talk first about that internal leadership succession. Who gets that next leadership role? If you're talking about the CEO of the company, are you going to move a finance person up into that role? Are you going to use a marketing person that you move up into that role? Are you going to use an ops or a pre-con person that you're moving up into the role? I will tell you that the move itself and who and their position that fills that sends a whole lot of signals to the external market. You move a CFO up, in general, most markets are going to indicate, wow, safer company, less risk, but more conservative on the growth side. And if you're going to then get bought by a heavy growth client, then they recognize they're going to have to do an awful lot of lifting to change the internal culture from conservative and pragmatic to fast growth. And that matters. Project management people can sometimes really get moved up into those senior leadership roles. Your business may operate a lot better, but if you grew up with a culture in the market of we're a handshake business, you're going to see the owners on site, you're going to know who we are, I'm going to come to your kid's soccer game as well as build your $50 million building. How do you manage all of those things? So the internal leadership succession matters, and it matters for employee culture and morale too. Bringing in an external sometimes can compromise that. Now, on the family succession side, very interesting. I work with an awful lot that do the family succession where you're not selling to an external owner, but you're identifying a family member or a group of family members that then take either a leadership role actively in the business or take an ownership role, are not in the direct management company, but they have very loud voice in the boardroom and in the owner room. Just involved with one where a non-family member was promoted up and above some other family members of the business. Recognize that might be the great leader for the business, but that if the family members are still developing, the scenario can be set up where they're reporting to the CEO that is a non-family member, but that CEO is reporting to them as an owner and a board member. So the CEO can get mad at them for their employee positions and correct them, but it comes at the risk of being fired or not being given incentive comp. So some of those structures and all that organization is really critical to pay attention to. And most people growing up in a family-held multi-generation business, many do not have experience in the outside, as to how those things are navigated, what's normal, what's not, and what's expected. So those things can become very challenging. We're going to talk now about some of the external succession and transition models. And Webb and I are in several of them together. And I think the challenge can be is if somebody's grown up in a privately held business and literally has said, I grew up driving around seeing the name of our family on signs with my friends and them asking about our family business. If that transitions external or outside the family, that's a different level of impact from a risk decision, from an emotional decision, and from people and how they grew up thinking their future identity would be. So those are some really critical pieces on the first couple of succession models.
Yeah, and to tack onto family succession really quick, from our perspective, one of the things that we really want to get ahead of is to properly navigate, valuation, and then, gift tax comes into play, potentially buyouts, and just tax consequences in general, because there are a lot of ways to miss all of the opportunities in the tax code. It gets really complicated. And, I touched on, you can set up trusts and move things around. I mean, there's lots of ways to shelter a lot of it. Of course, you're gonna have to pay some tax, or somebody's gonna have to pay some tax, possibly, just depending on the value of it. But there's a lot of work there to be done to get it done right. The management buyout or minority buy-in, this is a common path we see, and probably one of the most fragile. Generally speaking, we're talking about good people and maybe not enough capital, right? So if the financials aren't strong, the bank conversation ends really quickly. I can't emphasize that enough. It's how do you maximize the value of the company? That's one starting point. The way we model these is just like a lender would. And if it doesn't cash flow on paper, it won't work in real life. Interest on the potential debt that they would incur to buy you out, right? You've got to factor that in. And that could be a big number, especially at today's rates. So just needs to be modeled properly, do the proper projections and planning all around that. And just do it all before you, even get in front of the bank. The next one here are ESOPs. So an ESOP, if anyone doesn't know, that's an employee stock option plan. These can be great tools, but they're not magic, right? They require stable earnings, lots of discipline, and really a long-term mindset. The owners cannot check out. Maybe if they already have a really strong leadership in place, they can, check out a little more, but it's not the same as an external sale or even an internal buyout. Like, they have to stay and run the business or do what they've been doing to make sure that the business continues to run, because you got to pay them back, right? That's how they get paid, really. These things are they're retirement plans, really. They're subject to ERISA. The ERISA is just like a 401k plan or a defined contribution plan is what they're considered. They work when the business is already financially healthy. They don't work otherwise. There's a lot of compliance costs. I'll touch on that in a second. And I'll touch on the advantages and disadvantages, because ESOPs are a really interesting one. They're pretty complicated, but once you understand them, I mean, it's definitely one that's worth taking a strong look at. So let me give you the basics really quickly here. What happens is the company sets up a trust to buy the owner's stock at a price set by an independent valuation firm. Now, generally speaking, these, if you're a specialty contractor, that might not be worth the same amount, on the free market. Sometimes you can get a better valuation in an ESOP. We've seen that happen. If it's a very marketable company, a strategic buyer might pay you way more than an ESOP. So it just depends on the type of company, market conditions, and lots of other factors. So employees do not buy into this, even though it kind of sounds like they do. They earn shares over time through company contributions. just like a 401k plan, right? This is a retirement plan. Shares are allocated based on compensation and service, and they vest over time. And then when an employee leaves or retires, the company buys the shares back at fair market value. They can roll them over into a different retirement plan if they want to defer the tax or however that works. So some basics on the tax and cash flow aspects. In S Corp, ESOP, the ESOP owned portion of earnings is generally not subject to federal income tax. And that tax benefit continues even after the selling owner is fully paid out. Employees are taxed when they receive distributions. So the ESOP will pay out distributions if they're approved by the board of directors, just like a retirement plan. That's very similar. Selling owners are taxed on the sale of stock, typically as capital gains. So when they sell their stock to the ESOP, they pay capital gains tax. And that's a better tax situation than an open market, because oftentimes if you sell in the open market, it's going to be an asset sale. So you're going to have to pay, you're going to have depreciation recapture, and a lot of that sale price is going to be at ordinary tax rates, which are really big on a sale. So there's a lot of tax planning opportunity there. There's also another really big one, if it works. It's called Section 1042 option. The company would have to convert to a C Corp if it's an S Corp. And what it does is it allows the selling owner to defer capital gains tax on the sale to the ESOP if you take those proceeds and invest them into qualified replacement property. So qualified replacement property is investments that are qualified investments under the IRS code. The kind of rub here is that tax is deferred, it's not eliminated. But if the owners die, I hate to say that, right? I don't want to put it out there, but if the owners die, then the heirs get a step up in basis. So it could be eliminated, that tax, if the owner dies holding this qualified replacement property. Very interesting. There's a lot of moving parts with an ESOP. We love diving into this stuff. It's, I'm a little sick in the head. I like getting into it. It's fun for me. Dividends on ESOP shares can be used to repay ESOP debt, which, oftentimes if you're doing this, you can get a private bank loan to buy out the owner, but then the ESOP needs to pay it back. That's non-taxable if dividends are to pay back that original debt. If dividends are paid to employees, it is taxable, generally speaking. Or if it's reinvested within the ESOP, it's non-taxable. So some of the advantages here are, it allows for a gradual sale of ownership and allows employees to share in the profits of the business through the ESOP. A lot of times that motivates employees. Can be very tax efficient if the business has stable cash flow. Some disadvantages: payment for the company happens over years instead of at closing. Setup compliance costs. Compliance costs alone, let's just ballpark it. It really depends on the ESOP, depends on the company, everything else. You're probably looking at another $100K a year in compliance costs. So it's not cheap to do an ESOP. It could be less, and it really depends on the scenario, but let's just pretend it's $100K a year for easy math. It costs a lot. The annual valuation costs and all the other compliance costs, those are real costs that need to be factored in. But the tax savings can, well outweigh those. So it could be worth it. Creates a long-term purchase obligation that must be planned very carefully, because if it goes bad, guess what? The owner that got these payouts got to pay it back. So that could be really bad if it doesn't work. Really quickly on external sale, strategic combo here. Buyers don't pay for potential. They pay for what's proven and transferable. And the best exits we see, again and again, we'll say this, they started years before anyone even started talking about selling. They involve due diligence, because any buyer is going to really do some diligence, and quality of earnings plays into that. a quick explanation of that. Quality of earnings review, it's a very deep dive into how earnings are generated and expense side too. So both the revenue and expense side. So what buyers do is they re-underwrite job costing, the WIP, the backlog, the margins, and all the owner add backs we talked about. They don't accept your numbers, they recreate them. And if you've ever been through a financial statement audit, I mean, that's easy compared to due diligence and quality of earnings, because that's a much deeper dive. What do you think, Bob?
Agreed. Why don't we jump on to the next one?
Yes, sir.
We're going to try and move through this fairly quickly and then ask for questions. So I'm trying to prime the pump for you guys for questions. We've got some case studies we can talk generally about, but let's get your questions. So we try and look at things in terms of a 5-step succession roadmap, define the succession goals and the structure and the timeline. Myself, a colleague of ours, we do a lot of strategic planning with construction businesses. Where do you want to go? What do you want to do? Most want growth. Many want growth. But if you've got an owner that says, hey, I want stability in my assets, and that's who's still got the controlling and voting rights of the company, and you've got other people that want to come in and run it and grow it, you're going to end up with a problem there. So really defining what succession is from the ownership controlling voting rights versus the leadership aspirations, that's a really critical step. A lot of people get that wrong, and it can be the difference between looking at it from an internal and an external piece. The organization and leadership assessment. Webb did a great job talking about how important risk is in the factoring of the value of the company, but also the leadership team. And so if you've got a strong leadership team, they may be very compelling to an external buyer. If you have a weak leadership team, you're not going to get as much money. You will not get the multiple on your EBITDA. And oftentimes, and I've run into this with a number of companies, when the senior, honest, trusted leader owner exits stage left, sometimes there's a named successor that doesn't have the confidence of other people, and people say, I'm out, and they leave the company. So recognizing who you have, what's their likelihood of staying there, that really matters. Even had a recent business where owners decided to exit several of the senior folks to bring up the next leadership within the organization because they aligned more to the strategic future that the company wanted to go. Very painful transition, but done in the right way, it's really helpful. So defining the future, looking at who's going to lead it, how they're going to lead it, what's the communication involved, and then looking at the financial and ops assessment. Webb, you want to take it from there?
Yeah, so the financial and ops assessment, I mean, really it's where optimism meets math, right? We review job costing, accuracy, profitability, tax exposure, and valuation readiness. I mean, before you go pay for an estimated values, you really need to get the books in line. And by the way, they look at, at least 3 years back, 5 or more is really the norm. So that's one of the reasons too that we say, hey, you got to start at least 5 years, because generally that EBITDA number, the starting point, it's an average of the last 5 years, and they can ramp it up if you've had a couple of really good years, and they can see that it's going to continue that way. The leadership development, financial preparation. From our aspect, we're talking cash flow planning, tax structuring, and risk mitigation. This is where the value is actually built, because small improvements here compound big time over time. Bob, you have anything on the leadership?
Yeah, I would just say that an owner or an internal or external is going to say, who's going to lead this forward? Are you able to put up the numbers on the scoreboard? That's the financials that you say you are. And this last stage of succession planning is you've made commitments. Are you demonstrating them? And are they for long enough that we as an upcoming owner or an external sale have confidence that your track and your projection and your trajectory is going to go where we think it is? That's the important part. This final stage is, don't put everything in place for to just get finished the month or the week before we go out to market. have some track record of where it's working, because we as a buyer want to make sure that have confidence we're paying what we're going to get. We're getting what we're going to pay for. So why don't we stop here? Maybe Janice, you can help us with any questions that have come from the audience.
We haven't had any questions come in yet. I'm sure I noticed that you guys had a lot of case studies and you might have some particulars in that. I'm wondering if that might prompt some. There looks like a good amount of detail in there.
Okay, great. Webb and I are confidential with the work that we do and the clients that we have. And so we are very careful not to disclose things that would help you all recognize them. So most of these are in concept, but they have huge elements of truth. I'll give you an example on the first case study. Business that had been around for 100 years, 4 generations alive from the founder of the business, or over the course of the 100 years. 3rd generation really developing the business to a market leader, tremendous performing business, highly sought after in the market. And actually we're able to run it with a very different kind of leadership component and strategy. Their financials were so strong and so compelling. External buyer came in and said, we have some questions about how you're doing this, but your margins, your consistency, and your market leadership make it off the chain. And they were acquired by private equity and have become the golden child of the whole private equity portfolio. What's interesting is it's very hard to replicate their structure in other operating businesses, but the private equity company's trying to figure out how to do that because their margins, their clients, their retention rate is impeccable. And so, great example, family-owned business that actually chose to go external because there was not identified family successor, but there were incredibly strong non-family successors and leaders in the company. And the family member CEO has chosen to stay around in the business for 3 to 5 years, to earn the payout, but also to transfer the knowledge and the experience that they've had, as well as the client and the financial relationships. So great success story. In some ways doesn't mark perfectly to all the hallmarks that we usually think. But when you're on the top of the market, you're making great margins and no one can explain it, but you've got 100 years of history behind you and growth, you're a valuable asset.
So the $120 million civil firm, they had no plan. Well, this is when they first, we first started talking about transition planning, which, by the way, this is one that Velocity and James Moore worked on together here. So they came to us, they had no plan, aging workforce, and they had real risk, even though they were growing at 20% year over year for the past 18 years or so. And the financials were pretty solid there. They had good internal controls, just no transition plan. Leadership issues were addressed with the help of Velocity and with us. We ramped up the financial systems, uncertainty dropped. And by the way, we had an original estimate of values performed, and all these issues were identified, which we expected, but it was just a first glance at, hey, let's look at current state, what's it really worth? And the value increased significantly after a number of years with further estimates of value and put the plan in place and then continuous improvement, right? Just like the last slide was talking about. After 7 years, the company was sold and they got a very good number. I'm not going to say the number because I don't want anyone to know the company I'm talking about, just in case. But it was a very good result for the owners. The next one here is a $35 million mechanical contractor. They had labor shortages.
Well, we might need to stop and jump forward to the final slide. I think, Janice, you had some wrap up, and we're coming towards the top of the hour. We want to make sure that you have a chance to wrap us up appropriately.
Well, before we do have a question from one of our viewers. So how much money should a subcontracting business doing $40 million a year in total revenue pay for leadership coaching? And when should they hire a CFO or contract out a CPA?
I'll let you touch on the leadership. That's sort of a loaded question. It depends.
It really is. It's hard to know. It's kind of like I need to build the building without any of the specs on it. What I would say is it matters if you're trying to grow your business and you want those leaders to be very successful, to accelerate the strategic goals or plans that the owners have set in place. It's not uncommon for us to have a $40 million business spending $50,000 to $70,000 a year on leadership, both in the executive coaching and on a leadership team development component.
From the financial side, when is a CFO appropriate? We often use the $50 million mark, but it's, again, like Bob said, if the business is growing, and that makes sense, because if I owned a $40 million company and I wasn't who I am, which is, really a CFO, a CPA, et cetera, I would outsource that to a fractional CFO, because you get a lot more bang for your buck there. You can pay a lot lower cost and still get the same result, as long as you've got a good controller there who's got the coding down, and then you get a fractional CFO on top of that who can really work with the controller and keep everything dialed in, and talk about with the owners, bigger picture stuff that maybe a controller doesn't have the knowledge, skills, and experience to handle.
Great. Thank you.
Okay.
That's a great question.
Well, if we're good to go, then we can just kind of wrap this up. It brings us to the end of today's session. Thank you very much, Webb and Bob, for sharing your expertise with us. If anyone in the audience has questions and didn't get a chance to post them, never fear, you've got Webb and Bob's contact information right there on the screen. Feel free to reach out with them with your questions or any concerns, or just to talk about your business. Also, you'll see on the screen a QR code for a downloadable succession planning framework checklist. It'll go into a little more detail about the 5 steps Webb and Bob discussed today. And also, as a reminder, both the PDF slide deck and the checklist are available in the handout section. So thank you once again for spending part of your afternoon with us. We hope you found the information helpful, and we look forward to seeing you at our next webinar. Bye, everyone, and take care.
Thanks,
Thank you all.